Any other comments on this topic? Okay. Rebecca Brady.
Rebecca Brady from AccuVest. I'd just like to get the panel's view on what they think will be the best strategies going forward for investments and asset allocations.
Okay, so take the current environment into account, think about what investors are supposed to do strategically. Jerry, you're an investor.
Well, not personally, but I represent investors, I guess. Obviously, for pension fund investors, particularly trustees of pension funds, that is a very difficult question. There is a right answer, but there's no one right answer for everybody, because it will depend on the type of scheme you have, the type of liabilities within that scheme, the liability profile, and to a large extent, particularly in defined benefit schemes, the strength of the employer covenant that you've got behind you. I think in general there is certainly a strong desire among trustees and some pressure as well coming from the Pensions Board as regulator to reduce risk and reduce volatility. But obviously there's still a need for return-seeking assets, and it's trying to find the right balance and the appropriate mix of return-seeking assets and monetary or assets that more closely match your liabilities. That can be quite difficult to decide. But I think trustees do need to decide on what that is, and then, depending where they currently are, they need to find a strategy and how to achieve it and over what time period.
Is this, for pension funds, is this not all going to be in the context, for most of them, of funding schemes that have to be approved?
Yes, and that's probably what makes it difficult, because there is almost an incentive to have more higher risk assets because you can get where you want to get to quickly. But you're running huge risks within that and huge levels of volatility. And certainly I think one of the things that the Pensions Board are preaching quite strongly is that if you do want to do that, you need to have an answer to the what if question. What if it doesn't work out at a 6% per annum return or 7% per annum return? Because if you have gone back to your employer as a scheme sponsor for more money, how long more can you keep going back to that well? And that's where there is a difficulty. I think somebody mentioned earlier, I think there does need to be more proper diversification. I think a lot of people who might have thought they were diversified have found out over the last couple of years they weren't really. And there needs to be a lot more time spent on looking at alternatives. Infrastructure is something that has been mentioned as an area the pension funds could look at. Obviously, there are practical issues and difficulties there, but it does have many of the characteristics, I think, of a type of investment that would match pension funds' needs and liabilities. I think pension fund investors also have a difficulty in that, on the one hand, they're long-term investors because the time span of a member of a pension fund from the day they join to effectively the day they retire and their pension stops, it could be anything up to 70 years. But pension fund can't always invest as long-term because they have to do annual reports in terms of where they are in terms of funding position on defined benefit schemes. So there is almost some conflict there. And then a lot of focus is spent on the defined benefit side because it's very clear you've got your assets, you've got your liabilities, and if you've got a gap, you have to deal with that. There's much less focus on defined contribution, which is becoming much more important and a much bigger area because the gap is still there, but it isn't as clear to people. And I think certainly on the defined contribution side, what trustees really need to do, and the most important aspect, I think, of almost the thing you have to get right in a defined contribution scheme, other than the contribution levels, are having a proper default fund in place. 80% of members will end up in the default fund. Most of them will assume, because the trustees have chosen that as the fund that's there for people who aren't prepared or aren't willing or not able to make a choice themselves, that the trustees will choose something nice and safe for them. And quite often default funds are funds that have quite a very high equity content and are not really the place where members would see themselves if they understood where they were and if it was explained to them properly. And just the other thing to add is we do have, when we talk about trustees, we often think of a group of people who spend a lot of time looking at this. a lot of time examining it and have a lot of expertise available to them. But we do have almost 100,000 pension schemes in Ireland, and clearly not the trustees of every scheme don't have the time or resource to do that. So I do think they do have to rely on advisors and investment management community to help them. And therefore it's very important that the right products are there and they're structured in the right way that help those people.
Of course, it's not all about pension funds. Charlie, do you have any general comments about the best strategy going forward?
Yeah, well, absolutely. But just a couple of comments of where we are and where we've come from. I think at this stage and right now is the relative return long-only game should be put to rest. It hasn't worked. It's failed. It failed 5 years ago. It's failed now. Without being too critical, the fact is that tins of beans have done better over the last 10 years. Looking forward is you hear the comment is the equity exposures. Equities, it seems, are the only game in town, and fund managers went into the current crisis some with as high exposures as 80%, based on the premises that stocks are the best investment in the long run, and that they're the safest for long-term investors. Well, actually, it's proven theoretically, is assuming a normal distribution. We won't get into the whole academics. Is that actually allocation should be not dependent on time, because the probability of loss.
You weren't going to get into the
the reduced probability of loss completely offsets by the maximum wealth at risk. And the reason why stocks are the safest asset for the long run, because returns exhibit mean reversion, which means that you have long periods of good returns, which are followed by long periods of poor returns. We had 1982 to 2000. We now have 2000 to 2009, when it's been rubbish. And that cycle has persisted over 2 centuries. If you look at the American data. Then looking at that, which the 80% equities, when valuations were still at the highest levels in generations, really didn't make any sense. But then even looking even further through that, the exposure to Irish equities is not justifiable on any grounds whatsoever, and the exposures still today are not justifiable. The fact is, a bank is a bank, and the whole premise that investing in something because it's close to you or it's in your own country makes no sense. It really doesn't, and because I've heard the argument being made that Warren Buffett invests in his circle of competence. Yeah, he invests in his circle of competence. So oil companies is his circle of competence. He invests in PetroChina. That's in China, not in America. So the idea you invest in something, or that Elan is the best pharmaceutical company in the world because it happens to be in Ireland, really none of that makes any sense. You shouldn't be exposed to it. But then we talk about is people have attempted to diversify, and we've had new emerging themes. Unfortunately, people have tended to invest in more equities. Those themes have been pursued through more equities, and in fact, those emerging themes tend to be high beta plays. So when there's a bear market, you get killed.
Kevin, you're an equity man. Your favourite asset class is being undermined here. What do you think?
Yeah, well, obviously, the cult of the equity has certainly come under massive attack. But I mean, we have to look at what happened right across the global system over the last 18 months to 2 years, and this was a collapse in asset values which hit every part of the market. It was a black swan event. It was the second worst performance in an equity market return since 1932. So you've got with all the data that we can use to analyse every major asset class was hit. Commodities were hit. Bond market collapsed. We had collapse in the equity market. So there wasn't very many places to protect you from such an extreme event. So to an extent, the question mark is, what type of market expectation do we have going forward, having been through what we've been through, and to see that possibly we've reached the bottom to a certain extent in investment terms in the equity market. We may have seen it in March, but let's look at what environment we could be dealing going forward. And you rightly point out that history shows that we do have prolonged periods of equity market underperformance and with prolonged periods of equity market outperformance. And certainly the bull run of 82 to 2000 was extreme, and that was obviously the foundation for a lot of long funds and the long fund strategy really getting hold in the psyche. But I think probably what we're going to see more of is possibly a 70s type environment, a rolling market, where it's much more difficult market to take a long-only strategy in, and possibly the whole use of absolute return versus that type of market situation is probably going to gain in credence. And there's also the biggest issue, and I think this comes back to the pension issue we were talking about earlier on, is the massive loss of dividend, loss of yield in the market. We obviously see the banks and the financial system, a whole collapse in income, and in the bond market, income is extremely difficult to get, and any income that's there is obviously in a higher risk zone. So that's a huge challenge for how pension funds will, I suppose, close the funding gap that they currently face. And long term, unfortunately, equities show to be the best inflation.